It's October 2025, and gold has just smashed through $4,200 per ounce for the first time ever. The metal has surged over 60% this year amid a frenzy of safe haven buying. One major player behind this rally, China's central bank. For 9 consecutive months up to mid-2025, the People's Bank of China, PBOC, has been steadily adding to its gold reserves. China's official hoard now stands at roughly 2,300 tons of gold, about 74 million troy ounces, valued around $240 billion, and making up an estimated 6 to 8% of China's foreign reserves. Beijing is on a gold buying spree unlike anything in its history. The urgent question is why? Is China making a savvy geopolitical hedge by stockpiling an unfreezable asset? Or is it gambling by buying into a market that's at record highs? This video will unpack China's massive gold accumulation and weigh the risks and rewards. To understand what's at stake, we first need to know why central banks hold gold at all. Gold is not just another commodity, it's a strategic asset in government vaults. Central banks typically keep the bulk of their reserves in foreign currencies, like US dollars, and bonds, like US Treasury debt. Gold, however, is the oldest reserve asset, one that has unique properties. No counterparty risk. Gold is no one's liability and carries no credit risk. A US Treasury bond depends on the US government's promise to repay. Gold depends on nothing but itself. Its value doesn't rely on any single sovereign's credibility, which is reassuring if you worry that your foreign assets could be defaulted on or seized. Global liquidity. Gold is universally accepted and can be sold or traded in any major financial center. In a crisis, central banks know they can raise dollars by selling gold because there's always a market for it. It's an internationally liquid asset outside any one country's control. Hedge against the dollar. Gold often has an inverse relationship with the US dollar. When the dollar weakens or when trust in dollar assets erodes, gold prices tend to rise. This makes gold a form of insurance in a reserve portfolio, a way to diversify away from the dollar. Central banks use gold to balance the risk of having most reserves in dollars or euro. Inflation and crisis protection. Gold is seen as a safe haven. During times of high inflation or geopolitical turmoil, gold's price usually increases while other assets tank. For example, if a central bank's home currency is losing value, gold can preserve purchasing power. And in extreme events like wars or sanctions, gold can't be frozen by foreign governments the way dollar assets can. It's a tangible asset that isn't tied to any electronic payment system or issuing country. These qualities explain why central banks around the world stopped selling gold and started buying in the 21st century. In fact, central banks as a group have been net buyers of gold each year since 2010. This trend accelerated after some major geopolitical shocks. In 2014, when Russia was hit with Western sanctions for annexing Crimea, the Kremlin sharply boosted its gold purchases as a safeguard. And in 2022, when the US and EU froze about $300 billion of Russia's foreign currency reserves following the Ukraine invasion, policymakers globally took notice. Suddenly, the unthinkable had happened. A G20 country's central bank reserves in dollars, euros, and pounds were rendered untouchable by sanctions. That highlighted gold's unique value. You can't freeze a gold bar or seize it from a foreign vault as easily, and many countries started bringing their gold home, just in case. Against that backdrop, it's easier to see why China, often at odds with US financial power, would want more gold. The PBOC has never explicitly stated its motives, but the strategic intent is widely inferred. As veteran analyst Ross Norman put it, after Russia lost access to its own reserve assets, central bankers around the world know this, and they are acting accordingly, acquiring more gold. In an era when a nation's dollar holdings could be frozen with the push of a button, to quote a former Chinese central bank governor, gold's allure as sanction-proof reserve has grown. China is now the 6th largest official holder of gold in the world, behind countries like the US, Germany, Italy, France, and Russia, with over 2,300 tons reported. But is China doing the right thing by loading up on gold now, with prices at all-time highs? To answer that, let's examine the story in 5 parts. First, the facts. Gold prices have skyrocketed. In the second quarter of 2025, the metal's price averaged around $3,280 per ounce, a record high quarterly average, up 40% from the previous year. And by October 2025, gold broke into a full-blown rally, breaching $4,200 per ounce for the first time. This isn't a slow, steady climb. It's a surge driven by investors seeking safety amidst rate cut bets, inflation worries, and geopolitical jitters. Gold is trading in uncharted territory. Now, China's role in this story. China's central bank has been one of the biggest buyers contributing to gold's ascent. From late 2022 through 2023, the PBOC quietly accumulated gold almost every month. It then paused purchases for about 6 months in mid-2024, a notable break in activity. But in November 2024, China resumed buying gold after that hiatus. Since then, it hasn't looked back. By July 2025, the PBOC marked its 9th straight month of gold increases, and it continued adding in August, September, and beyond. In total, over 2023 to 2025, China's official reserves grew by several hundred tons to reach roughly 2,303 tons as of Q3 2025. Why did China pause in mid-2024? It likely wasn't an accident. It hints at price discipline. Gold prices were climbing sharply in the first half of 2024, and central banks, including China, may have held off when the metal seemed too expensive in the short run. In fact, analysts note that as gold's price surges, central banks can dial back their buying for tactical reasons. China appears to have done exactly that. It paused when gold rallied in mid-2024, then bought the dip later in the year. This suggests the PBOC is price-sensitive and not simply panic buying at any cost. When gold briefly pulled back or stabilized, China stepped back into the market and kept accumulating. By resuming purchases at the end of 2024 and through 2025, China was effectively buying into momentum. This could be seen as confidence that high prices were justified, or as chasing a rally. By mid-October 2025, gold's momentum was tremendous. Prices were up over 60% year-to-date and hitting record after record. Market observers noted a confluence of bullish factors. Fears of a US economic slowdown prompting rate cuts, a weaker dollar, central bank demand, and even US-China trade tensions flaring up, with a new US administration raising tariffs, all feeding gold's rise. China's spree has made a dent in its reserves mix. Those approximately 2,300 tons of gold equal roughly 7% of China's total foreign reserves by value, depending on gold's price and the size of the FX reserves. A few years ago, gold was barely 2% of China's reserves. Now, it's a significant share. To put it in perspective, globally gold has also gained prominence. Thanks to surging prices and buying, gold overtook the euro as the second largest reserve asset in the world's central bank portfolios in 2024, after the US dollar. In fact, the total value of central banks' gold holdings is now higher than their holdings of US Treasury bonds, a stunning reversal of the last few decades. This is the environment in which China has been operating, one where gold is making a comeback to center stage. Importantly, China's consistent purchases, even as prices hit new highs, signal that Beijing views gold as a long-term strategic asset, not a short-term trade. The pause in 2024 showed they won't chase any price, but the brisk buying in 2025 shows a strong appetite for gold despite the rich prices. They have been methodically building their stash month after month. The PBOC's announcements, brief as they are, frame these additions as routine reserve management. Analysts like Zane Vauder of Oanda noted that continued purchases by one of the world's largest central banks signal strong underlying demand, a long-term, strategic policy decision. In other words, China is telegraphing that this gold accumulation is strategic, not speculative. But we must note the optics. China is buying near gold's all-time highs. This invites debate. Are they wise for getting ahead of further turmoil and de-dollarization? Or are they buying the top of a bubble? To answer that, we need to consider China's possible motivations. Why would China plow billions into gold, especially now. There are several compelling reasons from China's perspective, rooted in strategy and security. 1. Geopolitical hedge and sanction insurance. Gold is the asset you want if you're worried about your foreign reserves being frozen or seized. This concern is very real for China. Tensions with the US are high, and Chinese leaders watch the Russia scenario closely. When the EU recently floated a plan to use, not technically confiscate but effectively tap into, frozen Russian central bank assets to help rebuild Ukraine, it sent a chill through capitals like Beijing. If Russian dollar and euro reserves can be legally repurposed or immobilized, who's next? Gold, by contrast, can't be locked down by sanctions, especially if it's stored in your own vaults at home. It's an asset beyond the reach of any foreign government's political decisions. As one analyst put it, because gold is no one's liability and nobody's debt, its appeal is shining for central banks worried about the political security of their reserves. For China, which holds over $3 trillion in FX reserves, mostly in dollar assets, this is a big worry. Gold offers a form of financial sovereignty. You don't have to trust an issuer or a foreign central bank. In an age of financial warfare, that has immense value. This is essentially why China, and many others, are buying, to reduce vulnerability. Western sanctions showed that dollars can be turned off, frozen with a keystroke. Gold is a hard asset that can't be nullified digitally. The head of Bullion Vault Research, Adrian Ash, summed it up. Gold's appeal has grown for central banks, worried about the political security of their reserves. In short, gold is unseizable. It's like a firewall against geopolitical risk. 2. Diversifying away from the US dollar. China has been gradually reducing its reliance on US Treasury bonds and dollar assets. Over the past decade, China's holdings of US Treasuries have fallen from over $1.3 trillion to around $0.75 trillion, the lowest level since 2009. This isn't a coincidence. Chinese policymakers often voice concerns about the weaponization of the dollar and the long-term sustainability of US debt. By shifting some reserves into gold, China is making itself less beholden to US financial hegemony. Gold doesn't depend on US fiscal health or Federal Reserve policy. It's a way to rebalance the reserve portfolio. In fact, as gold's share has risen, China has also slightly increased holdings of other currencies, like the euro, and reduced US debt exposure. This is part of a broader strategy often called de-dollarization. Along with promoting the international use of its own currency, the yuan, China's gold buying helps diminish the dominance of the dollar over its economy. It's telling that in 2024, gold surpassed the euro in global central bank reserves. Emerging powers like China have spearheaded this shift away from dollar-centric reserves. 3. No yield? No problem. One traditional knock against gold is that it yields no interest, unlike bonds. But in the current environment, that argument is less persuasive. In the first half of the 2020s, interest rates were rising, but inflation was also high, meaning real interest rates, interest minus inflation, were often low or even negative. Central banks buying gold see it as a reasonable trade-off. It's a stable store of value when real yields are low. Plus, the opportunity cost of holding gold is lower when global bond yields aren't that attractive. As of late 2025, for example, US 10-year Treasury yields are around 3 to 4%, and falling with expected Fed rate cuts. Not a huge payoff, and that's in dollars, which could weaken. Meanwhile, gold's price appreciation has outpaced bonds. Over the last 20 years, gold's returns have been surprisingly strong, nearly matching the S&P 500 stock index with lower volatility. For a central bank, gold's risk-adjusted performance and lack of default risk make it quite appealing as part of reserves. 4. Domestic factors, culture and market support. China's gold strategy isn't happening in a vacuum. It aligns with domestic attitudes and actions. Culturally, gold is highly valued in China. Chinese consumers are among the world's largest purchasers of gold jewelry, coins, and bars. This means there is political and public support for holding gold. It's seen as a prudent store of value by households too. In fact, in the past couple of years, when China's property market was shaky and stocks were sluggish, Chinese investors poured into gold. By 2023, jewelry and bar demand in China had rebounded strongly. At one point in late 2023, local demand was so intense that the gold price in Shanghai ran over $100 per ounce higher than the international price. That Shanghai premium, normally just a few dollars, spiked to record levels, peaking above $120 in September 2023, because supply couldn't keep up. Essentially, Chinese buyers were willing to pay a lot extra to get their hands on gold. This was partly due to import quotas. The government was curbing gold imports to protect the yuan, but it showed how much trust Chinese savers place in gold. Even in early 2025, Chinese gold traded at a premium of $40 to $60 per ounce over London prices when demand was strong, though that later eased. Such domestic appetite provides a strong foundation for the PBOC's gold accumulation. It's unlikely to face criticism at home for holding more gold. If anything, it aligns with what many Chinese citizens are doing themselves for financial security. Moreover, there are signs of a coordinated or at least complementary push. Chinese financial institutions have launched gold-backed investment products, and China's gold ETFs saw massive inflows in 2025, especially as prices climbed. In the first 3 quarters of 2025, Chinese gold ETFs had their largest ever inflows, around 79 tons added, encouraged in part by the central bank's non-stop buying and the lack of attractive alternatives for investors. 5. A long-term strategic vision. Finally, consider the possibility that China is thinking decades ahead. Some analysts speculate China might be preparing for a more multipolar currency system, one where the US dollar is not as dominant. In such a world, having large gold reserves could bolster confidence in China's own currency, the renminbi, perhaps even supporting it if it ever wanted to partially back the yuan with gold, or create a digital currency with gold underpinning. These ideas are speculative, but not implausible. At the very least, China likely views gold as underheld by major powers. The US still values its gold stockpile, but many countries reduced gold in the past. Beijing might foresee gold continuing to revalue higher as global central banks, especially in the East and global South, keep buying to diversify reserves. Indeed, surveys show an overwhelming majority of central bank reserve managers expect global gold holdings to keep rising in the coming year. China is simply getting its share of that pie now. It's worth noting that central banks worldwide have been buying over 1,000 tons of gold annually since 2022, more than double the average in the prior 5 years, and this has contributed to gold's price strength. China likely believes this is a durable, structural trend, not a passing fad. In their view, they're early, or at least in good company, not late, to the gold party. No asset is a one-way bet. Gold may be a safe haven, but it's also notoriously volatile and cyclical. China's aggressive gold purchases in a hot market carry several risks. 1. Buying at the peak? The foremost concern, price risk. Gold prices are at all-time highs. If China is buying near the top and gold prices later correct downward, the PBOC could be staring at large mark-to-market losses on its holdings. For instance, imagine gold retraces from $4,200 per ounce to $3,300 per ounce in a future calm, which would still be a historically high price. That's a 20% plus drop. On approximately 74 million ounces of gold, such a move would wipe out roughly $50 billion in value. These would be paper losses, since central banks don't mark to market daily like a hedge fund might. But they are not irrelevant. A big plunge in gold would dent the value of China's reserves. It might also cause some political embarrassment domestically, i.e., why did we buy so high, if not carefully managed? By contrast, if China held that equivalent value in short-term US treasuries or cash, the value wouldn't swing so violently. In other words, China is trading stability for security. Gold protects against extreme scenarios, but introduces more price volatility to the reserves in the meantime. Right now, gold's price has a lot of bullishness baked in. There is a real possibility of a pullback or at least a plateau. The World Gold Council itself noted that the rapid price increase in 2025 may have raised near-term risks of a reversal or correction. If the economic outlook were to brighten or some uncertainties resolve, gold could easily slide. By buying so much at record levels, China has less margin of safety. Think of it this way. If gold were $1,500 and China bought a ton, a drop to $1,200, 20% decline, is painful, but the starting price was low. Buying at $4,000 plus, a 20% drop means losing more value per ounce than gold even cost a few years ago. Timing matters, even for central banks. 2. Opportunity cost. Gold versus yielding assets. Gold might shine in crises, but during normal times it yields nothing. Central banks traditionally hold interest-bearing assets, like government bonds, not just for safety, but also to earn some income on their reserves. Right now, US Treasury bonds and other high-quality bonds do offer interest. For example, a 10-year US Treasury in late 2025 yields around 3 to 4% annually. By reallocating reserves to gold, China forgoes that interest income. Over years, that's a significant cost. If inflation falls and those bond yields become solidly positive in real terms, holding gold has a high opportunity cost. In a scenario where, say, the US manages a soft landing economy, stays okay, inflation subdued and yields remain attractive, China might regret not earning interest on hundreds of billions of reserves. Gold also has storage and insurance costs, minor for a central bank relative to size, but not zero. It's a classic dilemma: gold versus bonds. Bonds pay regular coupons. Gold only pays if its price goes up. If we enter a period where inflation is low and stable and monetary policy isn't ultra-loose, in other words, if the world goes back to something like 1990s conditions, gold could stagnate or decline while bonds quietly collect coupons. By shifting toward gold, China is implicitly betting on a world of low real rates and high uncertainty. If instead we get higher real rates and stability, gold could underperform badly. In such a case, China's gold would be a costly holding relative to, say, just keeping money in dollars or investing in other sovereign bonds. 3. Herd mentality and market impact. One reason gold is so high is that central banks, including China, have been huge buyers recently. What happens if that demand cools off? There's a bit of a self-reinforcing loop. Central banks buy gold, price rises, more investors get bullish, price rises more. But if any major central banks pause or reduce purchases, perhaps because they feel they've bought enough at high prices, that could remove a key pillar of support for the gold market. China itself is such a large player that its actions can move sentiment. If the PBOC unexpectedly announced a halt to buying, traders would take it as a bearish signal on gold. In 2023 to 2024, central banks worldwide bought record amounts of gold, 1,100 tons in 2022, over 1,000 tons in 2023, this official sector buying more than doubled the 5-year average from before. It has undeniably been a factor driving prices up. However, it's unlikely that this pace can accelerate indefinitely. In fact, in 2025, the World Gold Council slightly downgraded its estimate for central bank gold purchases for the year, acknowledging that the 2022 spree was exceptional. Analysts still forecast large purchases. Metals Focus projected about 900 tons in 2025. But not every year can be a new record. If central banks collectively buy a bit less in 2025 to 2026, that demand gap might need to be filled by private investors to keep prices at lofty levels. There is a risk of herd reversal. The very central bank buying that boosted gold could fade, leaving the market top-heavy. China might find that it helped bid up the price and is now left holding the bag if others step back. It's a bit like a crowded trade. If everyone is overweight gold, who's left to buy more? 4. Paying a premium, import costs and market footprint. China's sheer size in the gold market means it can't easily hide its footprint. When it buys, it often has to pay up. We saw this in microcosm with the Shanghai premium. When Chinese demand outstripped supply, local prices jumped above global prices. Although the PBOC likely sources gold in various ways, direct from domestic mines, quietly through the international OTC market, etc., heavy sustained buying can push prices against you. Some analysts have mused that China might be consistently paying a China premium on gold. Essentially, its buying contributes to higher global prices, meaning it pays more for each additional ounce than it would have if it bought slower or earlier. One data point. Historically, China's market often had a $5 to $10 per ounce premium over London, but in periods of strong demand, that premium has run much higher. In 2023, it reached extremes above $50 or even $100. So China can end up buying gold at a higher effective cost than other players. Furthermore, gold is not infinitely liquid at these volumes. If China decided to suddenly sell a chunk of gold, or had to, it could move the market downward, which is a liquidity risk. Conversely, buying too aggressively could spook the market or cause price spikes that make subsequent purchases even more expensive. It's a delicate game for any central bank, how to acquire or dispose of large quantities without sloshing the market. China has managed its purchases stealthily, only reporting them after the fact. But the gold world watches PBOC data keenly. Any sign of slowdown or selling could hurt prices, meaning China could, in an unfortunate scenario, drive prices up on the way in and then see them drop if it stops, losing on the tail end. This push and pull effect is a risk when you're such a large actor in a relatively small market. Gold is deep, but central banks in total have accounted for a huge share of demand recently. 5. Scenario risk. If the world normalizes. Let's contemplate a scenario that is good for global stability but bad for gold. Suppose over the next few years, inflation globally comes under control, major economies avoid recessions, and geopolitical tensions ease somewhat. No new wars perhaps, détente in US-China trade issues. In that scenario, safe haven demand would likely ebb. Investors would rotate back to risk assets, or at least no longer hoard gold. Interest rates might stabilize, or even rise in real terms, if economies do well. The US dollar could strengthen if the US remains a growth engine. All these factors would put downward pressure on gold. It's not far-fetched. We've seen gold bull runs end before, when macro conditions shift. For example, after gold's last big peak in 2011, an improving economy and Fed tightening sent gold into a multi-year downturn. If something similar happened post-2025, China could find itself having bought the bulk of its gold at high prices, only to watch the metal slide. The opportunity cost would then manifest as regret. Those funds could have been in higher yielding or more stable assets. It might take years, or a new crisis, for gold to reclaim the price China paid. In essence, the costly gamble case is that China is overpaying due to FOMO, fear of missing out, on gold's rise, piling in late in the cycle. And if the feared geopolitical or inflationary crises don't fully materialize, gold could languish. HSBC, for instance, forecasted a wide trading range around approximately 3,100 to 3,600 through 2025, and gold easing to about $3,025 by 2026 in a more benign scenario. Their analysts warned that if growth surprises on the upside and inflation calms, the Fed might hold rates higher for longer, boosting the dollar and pressuring gold. That is exactly the kind of outcome that would make China's big gold bet look mistimed.